Our first panel of the day is on the macro outlook for 2022, and what an amazing and stellar panel it is as well. I'm delighted, very excited, slightly daunted, given this is quite a new experience for me, to be sitting here with two gurus and a virtual guru to discuss what's going to happen in markets next year. I will briefly introduce everyone, if I may. So Nigel Bolton is the co-CIO of BlackRock's fundamental equity group. Unless you've been living under a rock of any color, you'll know that BlackRock is the world's largest investment manager. Silvia Dall'Angelo, to my right, hello Silvia, is the senior economist at Federated Hermes. And Gurpreet, that you can see on screen in the opposite direction to me, which throws a logistical spanner in the works, is joining us from her home. Gurpreet is macro strategist at Goldman Sachs Asset Management. So it's a very well-balanced panel because we've got an economist, we've got someone with an equity focus, and we've got someone with a fixed income tilt. So hoping for a really good discussion. To dive in, I'm going to sort of ask this to all the panelists as a kind of a starter. But if you had to pick one, what would be your big theme going into next year, which will dictate the shape of markets, equity or bond or both? Silvia, I'll start with you.
So I think that the big theme for next year will probably be inflation, whether it will be temporary or more permanent. Obviously, after almost a year of high inflation, the temporary narrative has lost some traction. But I still think, in my baseline, really, that inflation, elevated inflation, is really mainly COVID-related. And so the result of shifts in demand, as basically consumers have moved away from services towards goods, and that has really boosted demand from goods and good inflation. And also, and I think more prominently, it has been due to supply issues. And so we are seeing supply chain disruptions, shortages in the labor market. And in my base case, as basically the pandemic evolves into an endemic equilibrium, we should see some correction in these supply-demand imbalances, and therefore a gradual descent in inflation starting after the winter months. But of course, there's a risk that some of these COVID-induced changes, and so as I said, a shift from services to goods in consumption, a lower participation rate in labor markets, and some changes in supply chains become more permanent, more structural, and therefore the picture of inflation might actually turn out to be permanently higher. And that's a risk that investors need to be aware of.
Thanks, Silvia. Nigel?
So I think from my perspective, when I look across the world, it's a positive growth environment. And actually probably a relatively high nominal growth environment. Although we would see real growth slowing a little bit in 2022 relative to the recovery we've seen in 2021, it's still going to be very much a supportive environment for risk assets. At the bottom of it is effectively negative real interest rates, which we see persisting, not just next year, actually, but for a considerable period of time going forward. I mean, I would personally think, we could be looking at decades of negative real interest rates. And that would not be particularly unusual if you look at very, very long term in history. And in that environment, actually, it's supportive for growth and it's supportive for real assets and equities as well. So I think it's still an environment where you want to be playing risk, but, and the caveat here, we're just going through it at the moment, there will be bumps along the way. We always knew at some stage there would be some kind of variance coming along. We've got to work our way through this one. We're much better equipped for that. So we still think next year, 2022, a positive growth year, and that's helpful for risk assets around the world.
Optimistic. And Gurpreet, can you?
Thanks. I would agree with those themes outlined. I think the key theme for fixed income investors is not just inflation, but importantly, how central banks are responding to the inflation environment. So inflation was the dominant theme in 2021. It's still going to be top of mind next year, but that focus will shift to policy normalization, which is what we're anticipating more of from more central banks in 2022. In 2021, it was largely EM central banks that started to hike rates. Next year, we have many more developed market banks beyond New Zealand and Norway starting to engage in rate hikes. And with the inflation backdrop, I would broadly agree with the comments discussed already. We think there are three words to keep in mind. The first is transitory, the second is underlying, and the third is uncertainty. So with respect to transitory, we're seeing that central banks are having to adapt their tone on the word transitory, just given the number of months it's been that we've had core inflation running above target. But there are country differences to keep in mind. So Europe has only just moved above target with respect to core inflation, whereas core inflation has been above 2% for 7 months in the US this year, but just 4 months in the UK. And the next word in focus is underlying. And what we would say is, though, that even though we expect many of the drivers of inflation to prove to be transitory because they are related to supply-constrained durable goods, for example, we are taking note that we're starting to see movement in underlying drivers of inflation. So the two key signposts of medium-term inflation pressures is wage growth and inflation expectations. And both of those metrics are painting a much firmer picture of inflation than they did pre-pandemic. And so I think all that said, that takes me to my final point, which is uncertainty. And with at the risk of complicating matters, there is potential for those underlying measures to be transitory, because we could see that labour force participation picks up, that eases wage growth, and you could see that inflation expectations begin to cool down due to lower energy prices or due to virus developments and so forth. And so what we're very focused on is what's happening with inflation in terms of second round effects. And I think one anecdotal survey to pay close attention to is that in the United States, we're seeing that surveys indicate households are delaying purchases because of high prices rather than pulling forward prices. And so it doesn't necessarily seem like we're entering an inflation spiral just yet. And how central banks respond to this is key, because that is going to dictate whether you see rates rise in a steady fashion and whether you see risk assets are able to digest that policy normalization. So I guess to sum up, we are very hopeful, and we do hope that year 3 of the pandemic is much more positive on the health front, but we don't think it's going to be any less eventful when you think about the macro and the policy environment.
Thanks for that. Well, I mean, that sounds, all things considered, quite glass half full. And Nigel, your glass was pretty full. And so if we could just stick with inflation just for a moment, I'm sure it will come up again and again during the course of the day. But Nigel, from an equities point of view, just thinking about companies and the way that they will think about inflation, and in Gurpreet's point, perhaps it is transitory. But to what extent, when you're looking at companies, are you looking at their inflation resilience? And if you are, what kind of makes a company inflation resilient?
It's absolutely a key part of our analysis at the moment, and we do think we're moving into an environment where it's going to be really important that you have the right companies. I think for the last 12 months or so in the recovery, you've kind of had certain sectors that have done well, whether it's been financials, you've had energy leading the way, but you also had technology doing well as well. I think you're now going to get into a much more differentiated environment over the next few years, where individual companies' ability to control the pricing of their products, control the pricing of their inputs, their cost of inflation, is going to be really, really important. And you started to see some of that coming through just in the latest Q3 results for companies. So, we refer to high quality management. We have an intrinsic bias within our investment processes towards investing in companies that are regarded as high quality. What does that really mean? That means that they are management who are able to control their business, have got good sight of both their supply chains, how they can control that, diversification of supply. Is it actually the best interest of your company that you've got one single supplier where you've absolutely nailed them to the floor in your costs? I think the last 6 months has shown you that's not been the best strategy. So having diversification of supply, maybe you do pay a little bit higher for that, but actually that's probably more important. And we've definitely seen a shift in company management from maybe lowest cost, just in time type kind of mentality to more like just in case, let's make sure our supply chains are really resilient. And then at the other side of that, it's your pricing power of your services or goods that you're actually selling. And again, we've seen examples where companies have been able to actually increase their margin in their Q3 results because they've been able to push their prices up higher than their raw material prices have been going up. And you've had some really interesting examples across lots of different industries just over this last month or so about that coming through. And that's about your brand power. It's about your quality of your service, your quality of your product, that differentiation. You're not just competing on price anymore. So I think the pricing environment actually is not just a transient thing that's going to dissipate over the next few months. I think this has got much, much longer legs to it. And therefore that stock selection process is going to be really, really important to identify those companies that have control of their supply and have got pricing power at the end of it.
And really quickly on that, partly because it's so gratifying for a PR and communications company to hear that brand is like a really material aspect in kind of what you're looking at. But are management teams generally good at conveying their kind of price flexing ability? Because I guess it's something that they haven't had to do to this extent for quite some time.
It's a really good point. I think there are some industries where you've just had no pricing ability for several years, and now suddenly that's kind of changing. So I think there is a learning process going on there for management. I think you're absolutely right. I mean, we had a rather large UK company reporting a few days ago in the building construction materials sector. They have some very, very strong branded products within their lineup. What they were able to do was actually expand their margin because although they were paying, in some cases, 50% more for some of their raw materials, basic things like copper and plastic and stuff like that on a year-on-year basis, actually they're able to incrementally add more into their final product price because of the quality of their product and therefore push their margins up. And that's actually a typical example we've seen across a lot of different companies in a lot of different industries.
And obviously we've talked about the inflationary impact on equities a bit there, but Gurpreet, from your point of view, are there any corners of the fixed income market that look particularly attractive or unattractive to you in a rising inflationary environment, albeit potentially transient, as you said?
Yeah, I guess in the macro rate space, we're looking at where you've got divergent inflation trends. And I just mentioned earlier that in Europe, you've only just started to see core inflation move above target. And we think that the impulse from energy prices in Europe likely peaked in November, and you are going to start to see inflation in Europe come back down in 2022, whereas in the US, the environment is slightly different, and you are seeing that labour force supply is not coming back to the extent expected, and that can give rise to macro rates opportunities. One market where we do think the inflation process is much weaker than what the market prices for the central bank policy is Australia, for example. So we have a bias to like Australian rates. And then when it comes to credit markets, I would agree with Nigel's comment just mentioned in that there's going to be much more differentiation next year, and so it's all about security selection from a bottom-up perspective and looking at companies that have resilient balance sheets. Interestingly, I heard from our investment grade analysts this morning that December is on course to be one of the busiest Decembers on record in terms of new supply, and so we've seen companies really use and take advantage of the low yield environment to issue debt and to restore balance sheet positions. And next year we're going to be really mindful of what they do with all that cash that they have amassed and how they're navigating the higher inflation and higher cost environment, and whether they're able to pass on those costs through pricing power and preserve their competitive advantages and their revenue growth and so forth. And so we think it's going to give rise to opportunities in credit markets.
And we can't really talk about inflation without talking about central banks. So it's probably a good moment to touch on what their decisions might be next year. Silvia, do you have a view on, not to put you on, well, to put you on the spot actually, how many rate rises, we might see in the US, UK, Europe next year? If you had to, what would be your forecast?
Again, in my base case scenario, where basically we see some moderation in inflation after the winter months, and also some residual slack in the labor market, as I really think that in the US as well, we probably see a gradual increase in the participation rate, and so there's still some residual slack in the labor market. And so in this scenario, I think that central banks will eventually move quite slowly. And so, of course, we'll continue to see a gradual removal of all the emergency-related measures. But in terms of monetary policy rates, I think that the path will be very gradual. And also, as you suggested, there will be divergences across countries. So I think that in the US, we'll probably see a couple of interest rate hikes. As you all know, Chair Powell a couple of weeks ago suggested that the Fed will likely speed up the process of tapering, and it will announce that at its meeting next week. And I think that the Fed is really trying to build up optionality there, and so the flexibility to move earlier if needed because of inflation. But in their base case, I think that really they're looking at a couple of interest rate hikes in the second half of next year. Moving to the ECB, I think while the ECB is like facing a completely different inflation picture, there's still some residual slack in the economy in the Eurozone, as typically the Eurozone cycle lags the US one by a couple of quarters, and I mean this time around is no exception. And of course, I mean, inflationary dynamics in the Eurozone tend to be more muted, and so we've seen still muted wage dynamics. And I think that the ECB assessment that medium-term inflationary dynamics are still muted is quite correct. And so I think that the ECB actually won't move its interest rates next year, and rather it will start probably in 2023. And that said, the ECB has like a big challenge in terms of basically reviewing the framework for its asset purchases. I think that at its meeting next week, the ECB will likely basically announce that the PEP, its Pandemic Emergency Purchasing Program, will end at the end of March of next year, as basically previously expected. But they will probably avoid a discussion about the future of the APP. And here it's like a big question mark. The ECB is also facing like an increasing trade-off between supporting short-term growth and elevated inflation. So again, I think the ECB is also trying to build up some optionality in terms of the future of its asset purchasing program. Eventually, I still think that the ECB will probably beef up a bit its APP, and also it will make it more flexible in line with the PEP. Finally, the UK. I mean, the Bank of England has been a bit of a loose cannon, if I may say so, recently. So basically, it suggested that a rate hike could happen as early as November. Markets were fully pricing a rate hike, and instead they got cold feet. And I think that that will likely happen again next week. We've heard from Michael Saunders last week. He's the most hawkish MPC member, and basically he suggested that there's a reason to wait for more data on the labor market and more data on Omicron, as clearly that's a new source of uncertainty. And so I think that the Bank of England will probably start its hiking cycle next year in February. So, I mean, the Bank of England will lead the hiking cycle across major central banks, but it is starting a bit later than previously expected. After the first rate hike in February, I think that the Bank of England will also be quite gradual and cautious in hiking rates. So again, in my base case scenario, monetary policy will remain fairly accommodative, and this low for long environment will likely continue.
So a couple of hikes next year in America, starting February in the UK, nothing doing in the ECB until 2023. And and you mentioned obviously the Omicron uncertainty. I mean, it's a elephant in the room, and before a week or so ago, Nigel, the equity markets in the US and Europe were up about 20%. I mean, that's not the case now, but do you think the downward movement that we've seen very recently are a kind of a blip caused by Omicron rearing its ugly head, or do you think we'll get back on track quickly, and or do you think that perhaps the market movement's a part of a correction that was maybe overdue anyway?
Well, if you look at the last few days, we actually have already kind of covered a lot of that fall. Look, markets have come a long way in the last 12 months, and I think we've said for the last few months that we're going to be in a period now where there is likely to be more volatility. We didn't know Omicron was coming, of course, but at the stage we're getting to, you've had that recovery phase. We're now into the delivery phase, so it's more kind of thinking along the lines of a sort of more mid-cycle. Exactly what Silvia said in terms of at the edges we're going to see some sort of, I wouldn't say tightening, because that gives the impression it's real tightening. It's not real tightening, but it's going to be less relaxed than it was before from central banks. So that provides a little bit of a headwind towards equities, risk assets out there. But for us, it's going to be very, very cautious and very, very slow. And the key for equities is going to be the ability to deliver earnings growth. And in this world where we do see pretty good nominal growth, inflation is going to be a little bit higher than it has been for some time. You want to be in assets that give you protection to that, and equities is exactly part of that. So it's that fine line between we don't want rates going up too fast because that will worry everybody, and then you get some earnings recession. We don't see that scenario happening, but there's always that policy risk out there. And then it's that earnings growth, and that's going to be very company specific, as I mentioned earlier. And I think if you can get companies that are going to beat the expectations, it's all about beating earnings expectations next year, delivering better earnings, whether it's through margins or better volume growth, that's going to be the stocks that will do well in 2022, in my view.
And Nigel mentioned, the general picture for growth. And Gurpreet, outside of equity markets and thinking kind of more broadly about the global economic picture, given we've got this kind of curveball in terms of Omicron that can kind of flare up at any given moment, and you mentioned that the outlook is kind of very uncertain. Do you have a view on how you see the rate of growth in different economies? I mean, the health of different economies, US versus UK versus Europe versus Asia next year. Do you have could you give us a sense of your economic health barometer for those regions?
Yeah, I think at a global level we expect growth to still be above trend next year, and you've got a boost to consumption from pent-up savings still. You still have relatively accommodative policy globally, and the path for normalisation we think will be gradual, but there will, like you said, be country differences. We think the US economy will remain robust for most of the year, but at some point you will have the impact of fading fiscal support, but that will be somewhat offset by still healthy consumption, depending on what happens with the labour market. And we will likely see a building of inventories, which will support growth in the US as well. In the UK, we'd be slightly mindful of the fact that the economy is faced with both the pandemic shock and the Brexit shock. And so improvements on the supply side of the economy may be slightly slower coming in the UK. And that's actually one of the reasons why we think that the Bank of England's hiking cycle will be relatively short-lived and front-loaded. It's also worth bearing in mind that in the UK, once the policy rate reaches 0.5%, at that point the Bank of England will cease reinvesting maturing securities on its balance sheet, and so you're going to have balance sheet unwind commencing. And so that's why we think that the policy stance in the UK will pause, and you'll have a prolonged pause after the policy rate gets to around 75 basis points. And then in Europe, we would say, as Silvia just mentioned, it seems to be a couple of quarters slightly lagging behind what's happening in the US. And you even prior to the onset of Omicron, you had renewed restrictions due to spread of Delta, and so that could be a near-term headwind to growth in the euro area. I think big picture thinking in terms of what risks does Omicron present, we think in the near term you could see growth is slightly more muted, but that would likely be followed by a pickup and improvement in growth in the second half of next year, hopefully once we have vaccination rates and boosters pick up. And then in terms of thinking about what Omicron means for the demand and the supply side and what that means for inflation, we think that it could be both a demand and a supply shock. And so it's going to be important to see what happens in terms of voluntary behaviour beyond actual lockdown and restrictions that are introduced. And then finally, I would say on China, we do expect growth to slow next year from around 7.8% this year to 5% next year. That is a slow rate of growth in the context of China, but still solid when you compare to other economies. But we think that's because in China, the focus is shifting to growth resilience rather than the quantity and quantum of growth, and more stability and a focus on higher quality growth. And we don't think that the focus on cracking down on leverage in the property sector and also regulatory tightening is going to ease up, given the focus on things like common prosperity and dual circulation.
Great. I'm conscious that in a moment or two, we're going to sort of hit the Q&A part of this session. But before I do that, I was wondering if we might have a quick fire round of sorts. And given what we've just discussed and the macro backdrop that you've all outlined, if you could each give me one asset type, I guess, a sector, a currency, because obviously, Nigel, you're not allowed to say equities. That's cheating. A sector, a currency, a geography, an area of the bond market or the credit market that you would be overweight or underweight in going into next year. Your big pick, as it were. So maybe Nigel, I'll start with you.
Yeah, I would go for European industrial equities. The reason for it is really strong earnings growth coming through, not just next year, but actually looking out over the next 5+ years. They're one of the biggest beneficiaries of the investment that we're going to see into sustainability. It's things like heating and ventilation systems. It's companies that have to insulate all their properties. There's just a staggering long-term investment that's going to carry over the next few decades. And we haven't really touched on sustainability. It's a very key driver, and it's for some businesses it's going to be a cost. It won't necessarily improve their output. It's another reason why I do think the inflation is going to be higher going forward than it has been for the last 10 years, because there's a lot of investment needed into that whole area. It's not necessarily going to increase productivity as such, but it's going to save the world. So that's an essential. If you're on the suppliers into that kind of area, then you can do really, really well. Heating and ventilation systems, those kind of things, insulation type products, those type of companies can do really, really well. So industrials generally, and in particular that niche area, I think is very interesting. Interesting.
Gurpreet, a tip?
Yeah, I would say I'd actually base it on a theme, and so I would agree with Nigel there in terms of sustainability being a key theme, and our colleagues in our equity team always talk about how technology is not a single sector, every sector is technology, and we think the same applies for sustainability. And so I think what's going to be key is in credit markets, and we're actually overweight credit with a preference for high yield at the moment, is to think about those bottom-up opportunities on companies that are geared towards the climate transition or advancing more inclusive growth. And just to give you one example, we like a high yield rated company that is installing electric vehicle charging points throughout Europe, and we think that is a good cyclical and a structural story.
Great. Final word, Silvia? I know, slightly unfair question, because as an economist you don't have a portfolio, but if you did, what asset would you pick?
Well, I'll adopt a slightly different angle. So again, in my base case scenario, growth should continue next year, so the recovery should continue. Obviously at a somewhat slower pace compared to this year, but also possibly in a somewhat less volatile fashion compared to this year. So the macroeconomic backdrop should continue to remain supportive of financial markets and in particular of equities, I would say. That said, there are also a lot of sources of risks, and we haven't really talked about that. And as an economist, I'll try, to temper a bit the optimism here. So, of course, we have seen that there is still like a degree of residual uncertainty about the evolution of the pandemic. And, of course, we might see new variants emerging down the line. Obviously, these new variants could have both an impact on demand and supply, but I would say that on balance, they probably cause new supply disruptions and therefore weigh on economic activity while also boosting inflation. Then, of course, the recovery has been also quite uneven, with basically emerging markets lagging advanced economies, and this divergence is really a source of fragility, not just in the short term, but also in the long term, as we need to have an inclusive recovery in order to tackle bigger existential challenges like climate change, the fight with climate change. And then, of course, we also have a new set of geopolitical risks. And so we have seen, like in recent days, tensions between Russia and Ukraine, obviously involving Europe and the US as well. I think the story of US-China competition in the tech arena will continue, and so we'll continue to see some tensions also, and with the possibility of a partial decoupling between the US and China going forward. And so again, we need to take into account all these risks as we proceed.
Great. Questions from Ben? Is there a mic?
I'm fairly loud.
Come on, mic people.
Is that working?
It is.
Sorry, Ben Martin from the Times. Nigel, I was interested in what you said about negative real interest rates. So you're expecting inflation to outstrip nominal rates for decades. Can you give us a bit more colour on that? Because obviously they're negative already in the UK, US, Germany. Are you talking about those areas specifically? Exactly how long do you think they'll remain negative, and what are the ramifications for that, for the economy?
Yeah, I'm definitely talking about the developed world there. And you've got to look at the level of debt, government debt to GDP. We are effectively the kind of levels we saw after World War II. And to get out of that situation, you do need a prolonged period of negative real interest rates. If you move interest rates up in any aggressive fashion, you're going to put absolute lock on the global economy and hurtle it into a big recession. So central banks are fully aware of that, and that's why they're not going to be able to do that. So they've got this fine line to kind of talk about, tightening to control inflation, but actually their firepower, I think, this time round is relatively limited. And I think you're going to have this prolonged period where nominal growth, yes, has to be higher than the nominal interest rates as you work through that long-term sort of overlaying debt position. You look at some long-term charts of debt to GDP, you can get vertigo looking at where they are. We moved up substantially after the global financial crisis, and we've just been on a massive, vertical wall through the whole COVID epidemic. So we need to have a very long, prolonged period of being able to work our way through that. That's the primary reason.
But that means inflation is going to remain higher than rates for decades.
I think you will have a higher... I don't think necessarily inflation runs away. I'm not arguing it's going to be like a double-digit inflationary world, but I think you do have a sustainably higher inflation rate. And there are lots of other things that are going on out there as well. There's the whole changes to supply chains. That, to me, is a slightly higher cost than we've been used to over the last few years. The whole supply of China that came onto the global system over the last 20, 30 years, that is changing. The dynamics of that are changing, and we're hearing it from companies, moving production from different parts of the world. If you look at the semiconductor industry, for example, again, moving production from certain areas where they've been, very invested, very efficient, to maybe in a slightly less efficient way, but having more diversity of supply. So moving it to Europe, moving it to the US, giving you that sort of more stability around that. And you're hearing that in other industries as well. And that ultimately leads to a slightly higher cost than you could have had the most efficient single plant in one area with massive scale. And that's replicated across lots of different areas.
I forgot to say at the outset, and I had been pre-prepped to do so, that people who are virtual attendees, please do use the functionality to submit questions. Don't be shy. I don't know if any have come in. Yeah, they have. Do you want to give me one from the virtual crowd.
This is from Mark Wood. Does the panel consider post-pandemic central bank targets need to rise, thereby enabling the erosion of debt burdens?
Gurpreet, do you want to take that one first? Did you hear that one?
I did. It's an interesting question. What we actually had pre-pandemic was central bank strategy reviews that would address that, dealing with the low inflation environment and the fact that after the global financial crisis, we had a cycle where inflation was below target. And we think that might actually be driving some of this tension and uncertainty in markets at present, because we have central banks who adopted new frameworks. You had the ECB reinforce its dovish forward guidance earlier this year. Last August, you had the Fed unveil its flexible average inflation targeting framework, but it didn't anticipate that a year after that, inflation would actually be above target, as it was aiming for as part of that framework, but also above target for lots of reasons that are uncertain and unclear and may prove to be transitory. And so that does lead people to think that we may be moving into a persistently higher inflation regime post-pandemic. I'm always hesitant to say that because, as you mentioned at the outset, we're still in the midst of the pandemic. I would say I don't necessarily think central banks would change their targets, because when we think about pulling apart inflation and where it's going to settle once a lot of those transitory policy and pandemic distortions subside, we actually think that inflation in the US will settle at around 2%, which is the target. And in Europe, we think that core inflation has maybe increased from its 1% average pre-pandemic to around 1.5%, and so it's still below target, even though it's slightly higher. But it's definitely something to be mindful of, and I would agree with the potential structural reflationary factors that Nigel outlined. Another potential structural reflation factor is so-called greenflation in terms of increases in investment to fund the climate transition and how that could generate inflation as well. But at the same time, it's worth keeping in mind that a lot of the structural downward forces on long-term neutral rates still remain intact. Chief among them is aging demographics and saving demand there. And so don't necessarily think we're going to be coming out of the pandemic in a lower rate or a lower inflation environment, but also not significantly higher.
Thank you. About 5 minutes left for questions. So anyone? Yes, sir.
Hi there. Hi, Nick Rowe from RX Asset Management. One of the big drivers, obviously, for inflation, particularly in the US, is the energy prices. And if you pick up any banks' analyst reports around the prediction of where energy prices will go, it's all over the map. It's been the tail on the donkey. And Morgan Stanley have been very bold in saying that they think that crude will get to 150 by the end of next year, which is pretty aggressive. Obviously, it's hitting the man on the street in the pocket, particularly in the US. So wage growth isn't necessarily negated by the fact that obviously they're having to pay more for goods and particularly for their fuel. Just the question being sort of how do you think that will play out over the next year and a half, particularly the energy sector?
Silvia, do you want to take that one first?
Yeah, so I think there has been like a convergence of factors contributing to this like higher energy inflation. The COVID pandemic has been one of those factors. As basically, as I said earlier, we've seen a shift in consumption patterns away from services to goods, and that has really boosted, I'd say, the demand for some components, for some inputs, including, I'd say, energy commodities. And so, I mean, this high energy inflation has also been fueled, in a way, by some COVID-related dynamics. And then, of course, I think that this pickup in demand that was triggered by the reopening after the COVID pandemic has possibly exposed some underlying supply issues in the energy sector. And so it is true that there has been like some underinvestment in some old economy sectors, and in particular in the energy sector. And at the same time, investment has been more concentrated in new technologies, renewable sources, and for good reasons, of course, as we are transitioning to net zero, and that is like an existential crisis that we need to deal with. That said, I mean, the renewable technologies are not fully reliable yet. There have been some problems also in terms of wind energy recently. And so it has all contributed to like high energy inflation. And I think that going forward, really, it's all about this transition to net zero. And so it will be like a bumpy process. We'll probably see again high prices of fossil fuels, but also eventually, I think that those prices are, set to decline. As I mean, we are talking about assets that will have to be replaced over time. So I think that's a trend, but there will be a lot of volatility around that trend. And so I wouldn't be surprised to see like some other temporary bouts of high energy prices. And then just one note on greenflation. Of course, I mean, it will be costly to invest in new technology to transition to net zero. But I mean, we're talking about investment that will also yield productivity gains over the long run. And so, I mean, if we have those investments boosting both demand and supply, then the inflationary impact should be eventually quite moderate. And we have an example, really. So the IEA agency has systematically overestimated the trajectory of the cost of renewable sources. And so in a way, technological advancement has been faster than expected. And if that's the case, I mean, again, this like inflationary environment could be not as concerning as many expect. And actually, eventually, technology could be a driver of lower inflation in the longer term.
And greenflation and energy are topics we'll definitely come back to throughout the day, including the next panel. Question?
Good morning, Chris Mallin. I had a couple of questions, if I may. Nigel, thank you very much for your insights. I just wondered, given your outlook of a positive growth environment but with low nominal interest rates, what does that mean in terms of asset allocation specifically relating to growth versus value? And even more specifically, given that we're in the UK, does that mean that UK equities just remain a value trap rather than an attractive asset class in a global environment? And maybe also to Silvia on asset purchases, given that Philip Lane is saying we have to consider this in the context of the supply of bonds, does that mean that asset purchase programs remain a lot more a feature of Europe, even though we see tapering in the US?
So I think, as I said earlier, I think it's going to be less about macro theme-driven market this next year. So it's going to be less than about value versus growth. You've had a performance of growth globally over the last 12 months, as you would expect at that in that recovery stage. And I think now you're getting into a much more differentiated environment where it'll be much more stock-specific, less about the macro themes, less growth and value. And I think you're starting to see that actually happen, even just coming out of the Q3 results. Companies that can actually beat, and you can be a value company, you can be a growth company, it doesn't really matter, but it's about your ability to deliver earnings above the consensus forecasts out there. I think that's going to be the story for next year. So I don't think it's going to be about growth and value next year. I think that game is kind of coming to an end. It's a much more stock-specific environment.
And a quick answer, because the red clock tells us we're out of time.
Yes, very quickly. So I think that, yes, a stronger QE program in the Eurozone will remain, let's say, a feature for the foreseeable future. I think the ECB will want to avoid the cliff edge effect at the expiry of the PEP in March of next year. So, and in this context of also supply of bonds, they will have, I think, to beef up their asset purchase program. So at the moment it's running at 20 billion euros per month. And I think that they will use any residual from the PEP envelope to beef up the APP. And possibly they will make it more flexible, so like open-ended. So they will have control, let's say, of the amounts as they go. And that probably makes more sense going forward. Also in terms of flexibility, they will I think, translate some of the PEP flexibility into the APP. And so, yes, I agree, the APP is here to stay, and the framework will probably be reinforced after the PEP expires.
Well, before we get the old shepherd's crook to take us off stage, just to say thank you very, very much indeed to the panellists. That was a great discussion. It could have gone on longer, but we're about to hit our next panel, which is going to be on sustainability. So thank you very much indeed.